Okay, let's dive right into this explainer because right now, one of the absolute most talked about yields in the entire stock market belongs to a household name. If you follow the pharmaceutical space at all, you already know that Pfizer is dangling a payout that's becoming kind of impossible to scroll past. We're talking about a massive global brand putting a seriously hefty sum right in front of income-focused investors. But, in the financial world, things are rarely as simple as they first appear on a stock ticker. So today, we're going to use the hard data to decode what this yield actually means for the future of the company, and, maybe more importantly, for anyone thinking about adding it to their portfolio. So the number that is literally pulling everyone in right now, 6.4%. Pfizer is currently offering this unusually high dividend yield, and it's a number that is incredibly difficult for income investors to just ignore, mostly because it sits way, way above what you typically get from the broader stock market today. When you see a yield sitting well over that 5% mark from a household name, it immediately demands your attention. But as we unpack this, we really have to recognize a fundamental rule of investing. A yield isn't high simply because a corporation woke up one morning and decided to be extraordinarily generous. But a dividend, this supersize presents a really fascinating mystery. Does it mean you've just stumbled onto an amazing bargain, or is the market actually warning you that something is fundamentally wrong? You see, dividend yield is basically just a simple math equation that's influenced by the stock price. When a stock's price falls significantly while the actual cash payout stays relatively stable, the yield naturally shoots up. So a 6.4% yield is kind of standing at a crossroads here. Down one path, it's this incredible opportunity to buy a giant at a steep discount. But down the other, it's a flashing red warning sign. And to be totally honest, Pfizer currently has plenty for investors to worry about. And that brings us to our primary clue in this investigation. Look at this. While Pfizer's revenue actually grew to $14.45 billion in Q1, their operating income dropped by 5% to $4.57 billion. Now, at first glance, a 5% increase in revenue year over year sounds really incredible, right? The business is clearly bringing in an enormous amount of money. But when you look just beneath the surface, the profitability picture just isn't moving in that same direction. Operating income is down. Essentially, they're generating more revenue, but they're keeping less of it as actual profit. And that matters enormously because at the end of the day, dividends need financial support from profits, not just top-line sales. To really grasp the hype here, let's just break down the hard cash. Right now, Pfizer is aiming for an annualized payout of approximately $1.72 per share. This right here is the tangible figure that's driving that massive 6.4% yield. Basically, if you buy a single share of Pfizer, the company intends to hand you $1.72 over the course of a year. When you break that down even further, it puts roughly 43 cents per share straight into your pocket every single quarter, like absolute clockwork. Every 3 months, the company is effectively cutting a check for 43 cents for every single share you own. When you frame it like that, you really start to see the immense appeal for investors who rely on their portfolios to generate that consistent, predictable cash flow to either fund their lifestyles or aggressively reinvest. To put that into perspective, let's say you're an investor holding 1,000 shares. You are looking at about $1,720 a year in purely passive income, assuming, of course, that the payout holds steady. It's an incredibly attractive number. But it begs the question, how exactly did Pfizer's stock drop enough to create this extreme high-yield scenario in the first place? Well, here's the absolutely crucial context. This yield isn't just a sign of generosity. It's high because the stock price fell off of a cliff as Pfizer's unprecedented COVID-19 vaccine and antiviral revenues collapsed. For Pfizer, the last few years saw literally one of the biggest temporary revenue explosions in all of pharmaceutical history. Enormous global demand meant just billions of dollars pouring in, but the pandemic emergency faded, and poof, that specific demand vanished. So Pfizer is now staring down a tremendous challenge. They have to replace a staggering amount of revenue that is simply not coming back. Investors are looking at this stock and they're asking not what Pfizer makes today, but what this company is going to look like 5 years from now. Because let's be real, promises don't pay dividends. Cash flow does. So we have to ask if they can actually afford this payout while still funding all their vital clinical trials, their acquisitions, and their debt. A sustainable dividend requires a business that's capable of producing enough cash to fund those shareholder payouts while simultaneously heavily investing in its own future. Pfizer needs immense capital for research and development, manufacturing, and buying up other companies to bolster their offerings. If cash flow weakens, management eventually faces incredibly tough choices. Do they cut research, take on more debt, or do they eventually have to reconsider that generous dividend payout? So what we have here is this perfect tug of war between the bulls and the bears. On one side, the bull case is pretty undeniable. I mean, this isn't some tiny startup, it's a giant with global scale, vast distribution networks, and a huge pipeline of next-generation medicines. If you buy in now, you essentially get paid to wait for that pipeline to mature. But the bear case? That's anchored by one terrifying word in the pharma world: patents. Successful drugs generate billions, sure, but patents eventually expire, letting generic competition come in and just destroy that revenue. Pfizer has to invent or acquire new drugs faster than their old drugs lose patent protection, all while trying to replace that lost COVID money. Adding some serious fuel to the bull case, CEO Albert Bourla recently went out and bought 38,000 shares with roughly $1 million of his very own money. It's a highly notable data point, though definitely not a guarantee of success. Look, when an insider, especially the CEO, puts significant personal capital on the line, the market pays attention. Executives inherently possess way more information about the internal workings of the business than us everyday investors. However, we have to be incredibly careful here. An insider purchase does not prove the stock is undervalued, and it absolutely does not guarantee the safety of the dividend. It's really just one fascinating data point to factor into our overall analysis. And wait, we really have to beware of a super dangerous mistake here. Earning a 6.4% dividend means absolutely nothing if the underlying stock falls 20% and destroys your total return. This is the classic trap of yield chasing. People see 6.4% and think, wow, that's better than almost everything else out there. But income is only half the equation, right? Imagine happily collecting your 6.4% over a year, only to watch the share price plummet by 20% because the company's drug pipeline failed to deliver. You're not ahead, you are substantially down. Professional investors don't just look at yield, they relentlessly focus on total return. So if we actually shift our perspective away from just staring at that yield, we uncover the real thesis of this explainer. You are making a bet on a highly complex post-COVID pharmaceutical turnaround. Honestly, this is the biggest misconception about Pfizer right now. It is not simply a quote-unquote dividend stock that you can just buy and forget about. If you invest here, you're essentially asking, can this company rebuild sustainable growth? Can it protect its profit margins? Can it develop the next generation of blockbuster drugs while still rewarding shareholders in the meantime? If the answer is yes, this stock might be incredibly cheap. But if it's no, that dividend is highly, highly vulnerable. To evaluate this turnaround effectively, you can't just casually watch the share price. You have to watch the engine. Is revenue growth accelerating, and are they actually converting it to operating profit? Keep a close eye on free cash flow and the payout ratio to ensure that dividend is safe. And most importantly, you need to monitor the absolute lifeblood of pharma: pipeline success versus upcoming patent expirations. Tracking these 7 vital financial and operational metrics every quarter is going to tell you infinitely more than the headline yield ever will. You have to ask yourself, what are you actually giving up to get that 6.4% yield? Well, the high yield is essentially the market's way of compensating you for accepting higher uncertainty, slower growth, and the inherent risks associated with developing brand new medicines. Every single investment has a price. When the market offers you a yield this far above the average, it's not a gift. It's the market explicitly telling you that you are taking on pipeline risk and uncertainty. They recognize there's significant patent exposure here. They need to compensate you heavily just to convince you to take on this level of unpredictability. You've got to decide if that premium payout is worth the turbulent ride. Ultimately, as we wrap up this explainer, the true bet isn't really on today's dividend. It's on the science of tomorrow. If Pfizer invents its future, you get paid handsomely to wait. If they don't, well, that 6.4% is just a mirage. So the big question you have to ask yourself before buying in is this: will Pfizer's next multi-billion-dollar breakthrough come from their labs, or will their next big headline be the breaking of their own dividend promise?